Good afternoon, everyone. My name is Salman, Senior Market Analyst for MultiBank Group. We pride ourselves in being one of the largest online financial derivatives providers. We service over 320,000 active clients. We provide also over 20,000 financial products across 6 different asset classes. We also provide some of the lowest spreads on gold CFDs, starting from 7 cents, and also highly competitive spreads on crypto CFDs as well. We have 25 offices globally, and we are regulated across 5 continents with over 11 financial regulators. So, is Bitcoin the new gold? That's the topic for today. And we'll be looking at the unique characteristics between the two, their fundamental drivers of return, and also the correlation of both assets. And so there's been a lot of debate and ongoing rivalry between the two. And some may argue that cryptos such as Bitcoin aren't even assets, simply due to the fact that assets have some form of cash flow or function that can be used to determine its fundamental value. And so when looking at shares, for example, they provide cash flow in the form of dividends. And so many analysts believe that cryptos are trading in a bubble. And as you may know, bubbles are formed when the price of something is trading way above its fundamental value. So we must wonder why many financial institutions and investors are still buying into Bitcoin, and what makes Bitcoin, which is highly volatile and speculative, to be considered a good store of value like gold. Well, to answer that, it's simply because the world has voted that they believe it is, and its potential for widespread social adoption, and more importantly, its strong and unique brand properties, such as the blockchain technology, which provides security, privacy, transferability, and the fact that it's digital, which makes it acceptable for future generations to use as a means of exchange. But in order for us to understand Bitcoin, we must also look at gold. And so we'll highlight some of the similarities and differences between the two. And so one clear similarity between gold and Bitcoin, they are both scarce in supply. And they both share popular uses as an inflation hedge and diversifiers in trading portfolios. And as for the differences, well, of course, one is physical and the other is digital. And one's been around for nearly 2,500 years and more, and Bitcoin's been around for nearly 11 years. Now, these characteristics alone are not enough to truly understand what drives both markets. So when we look at gold, for example, it has been always viewed as a stable store of value against a variety of risks, such as inflation, currency devaluation, financial crisis, and political and geopolitical risk. And we can see that gold's performance versus the S&P 500, especially outperforming the equity markets during depressed markets, specifically during the 70s recession, 2008 financial crisis, and more recently during the global pandemic, where gold reached all-time highs. And again, signifying gold's safe haven status and qualities against a variety of risks. And also, if we look at gold versus 10-year real yields, which account for inflation, we can see a strong negative relationship. All right, again, showing gold's inflation hedge purposes. And this is from early 2000 up until more recently. And now when looking at the drivers of return for Bitcoin, we must know that Bitcoin's prices are highly sensitive to the market's perception of future adoption. And we also must know that cryptos as a whole are still in its infancy. So it's better to think of today's prices as some probability that it could achieve greater future adoption. And so any changes in those probabilities would result in large price swings and high volatility. And so we can see that if we look at Bitcoin's timeline, a key critical ingredient behind Bitcoin's success is in its widespread social adoption. And this has been correlated with massive surges, especially when PayPal, a fintech company with over 294 million users, began to accept BTC as a means of exchange. Then Square adding $50 million worth of Bitcoin onto their balance sheet. And of course, Tesla, the sixth largest company in the S&P 500, to add $1.5 billion worth of Bitcoin investment. And so, another key fundamental driver for Bitcoin is in its scarcity. We must understand that artificial scarcity is programmed into the Bitcoin market. It is also known as halving. And halving occurs when the rate of newly mined Bitcoins are halved. And that occurs every 210,000 blocks are mined. And to put that in terms of time frames, it's nearly every 4 years. Now, why is this significant? Because it shows a further reduction in Bitcoin's circulating supply, and it has been correlated with massive surges 12 to 18 months after the halving had begun. So, as you can see from the first phase, 2012, we shot up from $12 to $1,150, representing nearly a 9,500% increase. Second phase, from 2016, from $650 to $20,000, representing nearly a 3,000% increase. And third and most recent phase in 2020, we went from $8,500 to its most recent all-time high, nearly $65,000, representing a 664% increase. Now, traders have to keep in mind that there was a sharp correction after each all-time high. However, the new low was always significantly higher than before. So reassuring traders and investors how resilient Bitcoin is. And so if we look at Bitcoin's volatility in comparison to that of gold, on a 5-year volatility in percentage terms, Bitcoin stands at around 85.4%. Compared that to gold, which is at 13.2%. So the difference is extremely significant volatility. So we cannot say that Bitcoin is a safe haven, and we cannot view it just yet as a stable store of value. And if we look at the correlation of Bitcoin with gold and other markets, we can see a very weak correlation between other markets, especially with gold, S&P 500, and crude oil. And now, it's important to remember that correlation is not fixed, and it changes and diverges over time. And this is where we start to see something more interesting, where gold and Bitcoin start to behave similarly. And this was specifically during the March FOMC meeting, when Federal Reserve Chairman Powell came up with a clear dovish stance on Fed tapering and interest rate policies, which sent the dollar index falling and yields to fall along with it. And gold shot up nearly 1%, whereas Bitcoin shot up nearly 4%. So representing nearly 4x the volatility. So to conclude, Bitcoin is not the new gold, and investors and traders should not pick one over the other. In this new age of investing, it is important to hold both assets because they show little to weak correlation to equity markets, and that would be crucial in order to generate outsized returns in times of uncertainty. I hope you guys liked the presentation. You can come meet me at booth 28, and we can have a more personalized discussion and talk about trading strategies moving forward. Thank you.